Hello, yes, good afternoon, everybody. Today is 24th of August. So today, the webinar for today, the title for today is Profitable Risk Management Strategy. So we've already covered something like this in the past, but we just want to build on what we said previously. There's some few things which I want us to know first before we start anything. So successful trading is not just about having a good strategy or knowing what to do, but it involves knowing what to risk and knowing what to get from every risk. So other than the fact that you have a good strategy, you also need to have a very good risk management strategy behind the strategy you are using right now. So the first thing is to have a strategy, a normal strategy. Maybe you're trading engulfing candle, pin bar candle, or whichever candle you're trading. Then the next thing, attach a very good risk management strategy to that strategy itself. So that's when you can actually get something from the market. Otherwise, you'll always find yourself at a point where you keep losing, but you don't really understand why you're losing. So what is risk? I give it a very basic definition, that risk is how much you put in a trade. Reward is how much you expect from a given risk. So if you expect to get like 5% from 1%, that is 1% to 5%. You are risking 1% to get 5%. If you expect to get 2 to 6, it means you are risking 2% to get 6%. So that's the best definition. The definition of risk is how much you are risking in a trade, how much you're putting inside a trade, how much you are willing to lose in a trade. And the reward is how much you expect to get from a given trade or from a given amount which you've risked in the market. So look at my charts right now. Just look at what I'm going to do here. You see here, this is a demo account. First of all, this is the balance that is there. These are very bad trades. You can see there's no stop loss. This has take profit, there's no stop loss. This has a take profit and a stop loss at the same time. So let me show you something. Anytime this is a poor entry trade, a very big entry, very big lot size, the correct entry, this is the symbol, there is no stop loss, there is no take profit. This is the worst way anyone could enter trade. Don't just enter trades because you expect the price to somehow go your way, so you leave out the stop loss and also leave out the take profit. Don't do this. For every trade, there has to be a given profit and a given stop loss, because you don't expect the market to move indefinitely. At some point, the market must reverse. So if you have like this one here, if you have a very good uptrend and you pick a buy here, at least have your stop loss somewhere, maybe there, where if the price hits, you are out and then you step out completely. Don't just leave it blank, so that it's indefinite. That is, you expect that the price may go up indefinitely or it may come down indefinitely your way. Do not leave your trades open. Ensure that you have a limit. That is, you have a stop loss and you have a take profit. The next thing is, if you have one side, that is, you have take profit and don't have a stop loss, this is a sign of fear. It's usually a sign that you don't know exactly what to expect. You're just hoping that somehow the price may go your way and hit your take profit, but you're not taking care of the other side. If the price goes against you for any reason, what will happen? You're not taking care of that other thinking. So this is also not a good one. This is another worst way. The best one is where you have these two. You have a take profit and you have a stop loss, and you can see the results are a bit better compared to the others. Are we on the same page? So you don't find yourself in a situation where you're having a trade which has a stop loss but does not have the take profit, or you're having a trade which has a take profit but does not have a stop loss, or you have a trade which does not have both of them. This is the worst way of trading. It's never the best way of trading at all. So how do you know exactly where to have your stop loss or where to have your take profit? So for that one, I do use an indicator. We have this one. It is a standard indicator, so you could get it anywhere. This one here, you use the default setting. The zigzag indicator, you use its default settings. So I want to make it a bit big. You can see that, you can see that here, you can see it. There is a move down, there is a pullback, there is a move down, there is a pullback, there is a move down, then there is a pullback, then there is a move down, there is a pullback, there is a move down, there is a pullback, then there is a move down before there is this move upwards. So how do you know, first of all, that this trend is going to continue downwards so that you keep looking for sell positions? The answer is very simple. You first of all, assuming you're trading a break below the low, that is when the price goes below this low here, you pick a sell and you have a stop loss above this high here. So you'll pick a sell there, have a stop loss above this high, expecting the price to continue down. So that's exactly what happens. The price continues down. You'll sell it there. Your stop loss must be somewhere here. So in a case like this, our stop loss is actually our take profit. What that means is we are acting on the fact that we expect the price to at least go down for a very long time. So if you notice that is, if you notice that the price may likely go down, have your stop loss as take profit as far as possible, maybe somewhere here. This is some place in the future. It doesn't have to be anywhere specific, but somewhere very far away, where you know that the price may likely not hit it very soon. But if the price goes down like this, establishes something here, then comes up and then goes down, and you notice that this is another high, as the same as the one where you have your stop loss. You just drag this stop loss and put it at the top of this high here. So that's where our stop loss is going to be at now. We had the first one, we had the first, we have the entry here, we had the stop loss here. The price has formed a new high somewhere here, so we drag our stop loss and place it there. If the price goes down, comes up, then continues down and forms another high, you drag your stop loss again around it. Then when the price continues down and then pulls back up, it goes down and it forms this, you again drag your stop loss somewhere there. So when the price continues down and then comes up and it does something like this, you also drag it there. So you can see what happens. And in case the price goes down extensively, then you may actually just drag your stop loss above areas like this ones, like that, and then like this one here, then somewhere like this. So that would mean you are stopped out somewhere around this area here. So look at how much you earned from this point to this point. This is how many pips? This is let's see, this is around 250 pips. This is how much you could have earned if you're just tracking your trades. If you're tracking your stop losses, you just drag them based on the highs, you'd find yourself at a point where the price is here and you've earned all this just by trading a single trade. So this could not happen if you had some fixed take profit here and a fixed stop loss here. This could not have happened. This is one way of ensuring that you are actually protecting what you've earned. At the same time, you're increasing your rewards based on the initial risk that you took before. Does that make sense? It should, because we've actually looked at something like this in the past. You remember that we looked at the theory which says that for every risk of 1, you expect a reward of 2. We looked in depth at that strategy, and from what we saw is that it's always never the best one, but it could be profitable if you're looking at just one thing in the market. So if somebody says risk 1% for 2%, that theory works very well, but only if you have the same strategy or you have the discipline to remain the same strategy, then that will work for you. Otherwise, it won't work out completely. So the same thing would happen here. The same thing would happen, assuming we have this one, have this high, then we have our stop loss below it. So we suspect that maybe if it goes up, then comes down, establishes this high, this low, you continue, you drag the stop loss below it. If it goes up, you now drag it somewhere where it forms things like this. If it goes up, you drag it up to somewhere, maybe somewhere like that, then you're now stopped out of that trade. So in this case, probably you could have earned something like how much? Let's see, this is around 982. That is way better than if you had some small fixed take profit here and a small fixed stop loss here. It's the whole thing that I'm talking about is a strategy in itself. You could use it to trade, but there are cases where it could fail, like here, where you took a sell and then you had your stop loss above this high. This high, but somehow the price came up, hit the stop loss before eventually going down. So that was taken out. This is another good one where you could have taken a very good sell there. This is the place you could have sold from. Your stop loss is fixed at the high of this candle here, and the price goes down, it comes back up, goes down, establishes a high there, then you drag your stop loss and place it above that high. So in this case here, it is stopped out, so you could have stopped out there but with a very good profit. Then you take another sell somewhere here, could have taken a sell there. You have your stop loss at the high of that candle, so the price goes down, it pulls back up, and then it forms a high there, continues down. So when this happens, when you see this high has formed, you can just drag your stop loss from the high of this candle, place it there, you continue the same thing there, you continue the same thing there, the same thing, you pick it there, and then the same thing, you take it there. So just look at how much you could have earned from just that single trade. This is how much? This is let's see, this is around 200 pips, 197 pips to be precise. So this is why it's very useful to learn how to have dynamic stop losses and take profits. The first thing you must have is you must have some fixed stop loss. There is no extending stop losses. There is no extending. What that means is there is no moving stop loss further to the negative side. You can move it to the positive side, but not to the negative side. But the take profit, you cannot move it to the negative side. You have to keep moving it as away from the current price as possible, so that you can earn as much as possible. I hope that is clear. Let's get another example. So we have another one, this one. So it's not all the time that if you enter trade here and you have your stop loss here, that the price will continue to go down immediately and even form this high now. Sometimes you may enter trade here, the price pulls back up, continues up, and goes up and even hits your stop loss. So in such a case, you instead look for a buy position. There's no problem. So just pick a buy. If it goes the reverse the other way, you pick a buy position. So we have another one here. There's a break above, so this is upwards, continues up, retracement, continues up, retracement, continues up, retracement, continues up, retracement, then it continues up. So in this case, if you took the buy position somewhere here, you could have had your stop loss here. Then as the price goes up, you drag your stop loss, you drag it, you keep moving it until when it's here, then you step out somewhere there. So you can see how much profit that could be, because it's very useful that you learn how to earn more. You must be as opportunistic as possible. Don't just be lenient with trades, because I've seen cases where somebody would just enter trades when the trade is losing. When the trade is losing, they are very patient, but when they are making money, they step out quickly. So to avoid the idea of stepping out quickly or not going as far as possible, you must ensure that you are actually following something that will give you a standard way of getting out and a standard way of getting inside trade. That's the key. Get something which tells you the standard way of entering and the standard way of getting out of trades. If there's a trade which is not useful, you step out of it at a fixed price. If there's a trade that is useful, you also step into it. That's the secret. Does that make sense? Okay. So thank you very much. I hope that should make this is the only part which I didn't include on the other side. I hope that makes a lot of sense now. So we'll meet again next week at the same time. Thank you and see you.